All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to show you isn't speculation, it's not fear-mongering, and it's not something you'll hear from the talking heads on CNBC. The repo rate in the United States just spiked to 6%, and in Singapore we're seeing overnight rates hit 11%. Now, if those numbers don't immediately alarm you, they should, because what's happening right now in the plumbing of the global financial system is a warning shot that most people are going to miss until it's too late. This isn't just about some obscure corner of the bond market. This is about the architecture that holds up every pension fund, every bank balance, every retirement account, and every government bond on the planet. The dealers, the primary dealers who are supposed to keep this system liquid and functioning, are being cornered. They're running out of balance sheet space. They're refusing to take on more Treasury inventory. And the Federal Reserve is watching the entire mechanism seize up in real time. What we're witnessing is the early stages of a liquidity crisis that could make 2008 look like a dress rehearsal. By the end of this video, you're going to understand exactly why this is happening, what it means for your wealth, and most importantly, the 3 asymmetric plays you need to position yourself in right now before the window closes. This is not a drill. This is not theoretical. The math is undeniable, the mechanics are clear, and the opportunity to protect and multiply your wealth is sitting right in front of you if you know where to look. Let me introduce you to a concept that's going to frame everything we discuss today. It's called the Rule of 72. And if you've never heard of it, pay close attention because this is the foundation of how wealth compounds and how inflation destroys it. The Rule of 72 is simple. You take the number 72 and divide it by the rate of return or the rate of inflation. And that tells you how many years it takes for your money to double or for your purchasing power to get cut in half. If inflation is running at 6%, your purchasing power is cut in half every 12 years. If your investment is returning 10%, your wealth doubles every 7.2 years. This is the mathematical reality that governs every financial decision you make, whether you realize it or not. Now, here's where this gets critical. When real interest rates, the difference between nominal interest rates and inflation, go negative, you're in a regime of financial repression. That means the government is deliberately keeping interest rates below the rate of inflation to erode the real value of its debt. Your savings accounts, your bonds, your fixed income investments are all getting quietly destroyed, and most people don't even notice until it's too late. The thesis of this entire video is this. We are entering a period of sustained financial repression combined with episodic liquidity crises, and the only way to preserve and grow wealth in this environment is through asymmetric investing. That means you position yourself in assets that have limited downside but exponential upside when the system breaks. Gold, silver, and specific deep value plays in the commodity and resource sectors are the 3 pillars of this strategy. And the repo market blow-up we're seeing right now is the canary in the coal mine signaling that the time to act is now, not later. Let me take you back to 1933, right in the depths of the Great Depression. The United States was drowning in deflation, banks were collapsing, unemployment was at 25%, and the entire financial system was on the brink. President Franklin Delano Roosevelt made a move that most people today still don't fully understand. He confiscated gold from American citizens through Executive Order 6102, forcing them to exchange their gold for paper dollars at $20.67 per ounce. Then, once the government had concentrated all the gold, they revalued it to $35 per ounce. Overnight, the government effectively devalued the dollar by 69% against gold, wiping out a massive portion of the national debt in real terms and reflating the economy. The people who had already converted their wealth into physical gold before the confiscation, and those who held it outside the United States, saw their purchasing power explode. The people who trusted the system, who kept their wealth in cash and bonds, got destroyed. The lesson here is not that confiscation is coming tomorrow, although that's always a tail risk when governments get desperate. The lesson is that in times of systemic crisis, governments will always choose inflation and devaluation over default. They will always sacrifice the bondholders and the savers to preserve the system. And the people who position themselves in hard assets, in real money, in gold and silver, are the ones who come out ahead. Now fast forward to the 1970s. This is the closest modern parallel to what we're living through right now. You had stagflation, which is the combination of stagnant economic growth and high inflation, something the textbooks said was impossible. You had an energy crisis, geopolitical instability, a collapsing dollar, and skyrocketing government debt. The Bretton Woods system, which had pegged the dollar to gold at $35 an ounce, collapsed in 1971 when Nixon closed the gold window. From that moment, the dollar became a pure fiat currency, backed by nothing but the full faith and credit of the US government. And what happened to gold? It went from $35 an ounce in 1971 to over $800 by 1980. That's a 2,200% return in less than a decade. Silver did even better, going from $1.50 to $50, a 3,300% move. Meanwhile, if you were sitting in bonds or cash, you were getting annihilated by double-digit inflation. The purchasing power of the dollar was cut in half twice over. The people who understood the mechanics, who understood that when the Fed prints money and the government runs deficits, hard assets are the only safe haven, those people made generational wealth. The people who trusted the system, who believed the Fed when they said inflation was transitory, lost everything in real terms. And here's the critical piece most people miss. The 1970s weren't just about inflation. There were multiple liquidity crises along the way. There were credit crunches, banking panics, and moments where the overnight lending markets froze up, just like we're seeing right now with the repo spike. And every single time, the Fed had to step in, expand the balance sheet, and inject more liquidity. Every intervention made the long-term problem worse, but it also created another leg up for gold and silver. We're in the exact same pattern today, just with much bigger numbers. So let's get into the current mechanics of what's happening right now, because this is where the rubber meets the road. The repo market is the most important market that 99% of people have never heard of. It's the market where banks and financial institutions borrow cash overnight by posting collateral, usually U.S. Treasury bonds. It's the plumbing that keeps the entire financial system liquid. When the repo rate is stable and low, everything flows smoothly. When the repo rate spikes, it means there's a shortage of cash in the system, and institutions are scrambling to find liquidity. A 6% repo rate in the U.S. is not normal. A 11% repo rate in Singapore is a flashing red siren. What this tells us is that the primary dealers, the 24 banks that are obligated to make markets in U.S. Treasuries, are running out of balance sheet capacity. They've been forced to absorb trillions of dollars in new Treasury issuance over the last few years because the U.S. government is running deficits of nearly $2 trillion annually, and someone has to buy those bonds. The Fed stopped buying them when they started quantitative tightening. Foreign buyers, especially China and Japan, have been reducing their holdings. That leaves the dealers, and they're maxed out. When dealers can't take on more inventory, they demand a higher rate to lend cash in the repo market. That's what we're seeing. And when the repo rate spikes above the Fed funds rate, it's a sign that the Fed is losing control of short-term interest rates, which is exactly what happened in September of 2019, right before the pandemic. The Fed had to come in with emergency repo operations, and within months, they restarted quantitative easing, even though they swore they wouldn't. Now let's zoom out and look at the macro picture, because the repo spike is not happening in a vacuum. Global sovereign debt is now over $300 trillion. U.S. national debt just crossed $36 trillion and is accelerating. The interest expense on that debt is now over $1 trillion per year, which is more than the defense budget. Think about that. The U.S. government is spending more money just servicing the debt than it spends on the entire military. And with rates higher than they've been in 15 years, that interest expense is compounding faster than tax revenue can grow. This is the debt spiral, and there are only two ways out: default or inflate. Default is politically impossible, so they're going to choose inflation. But here's the trick. They can't just come out and say, we're going to inflate away the debt, because that would cause a bond market revolt. So instead, they use financial repression. They keep nominal interest rates below the rate of inflation, which means real interest rates are negative. Right now, if inflation is running at 4% and the 10-year Treasury is yielding 4.5%, that looks like a positive real rate. But if you adjust for the real cost of living, for food, energy, housing, healthcare, real inflation is closer to 7 or 8% for the average person. That means real rates are deeply negative, and your purchasing power is being eroded every single day you hold dollars or bonds. This is the quiet mechanism of wealth transfer from savers to debtors, and the biggest debtor in the world is the U.S. government. So where does gold and silver fit into all of this? Let me be extremely clear. Gold is not an investment. Gold is money. It's the only form of money that has survived every currency collapse, every hyperinflation, every sovereign default in human history. When the repo market is spiking and the dealers are cornered, that's a signal that confidence in the collateral, confidence in U.S. Treasuries, is starting to crack. And when confidence in the collateral cracks, people start looking for alternatives. That's why central banks around the world have been buying gold at a record pace. China, Russia, India, Turkey, they've been accumulating thousands of tons of gold over the last few years, not because they love shiny rocks, but because they know the dollar-based system is unsustainable. They're diversifying away from treasuries and into hard assets. And retail investors, the smart money, is starting to do the same. Gold is sitting near all-time highs in dollar terms, but it's actually undervalued relative to the monetary base, relative to the debt, and relative to the amount of currency that's been printed. If you adjust gold for the expansion of the Fed's balance sheet since 2008, gold should be well over $3,000 an ounce, potentially closer to $5,000. We're not even close to the mania phase yet. Silver is the asymmetric play within the asymmetric play. Silver has a unique dual nature. It's a monetary metal like gold, but it's also an industrial metal. It's used in solar panels, in electric vehicles, in electronics, in green energy infrastructure. The supply-demand dynamics are incredibly tight. We're running structural deficits in the silver market, meaning demand is outstripping supply, and above-ground inventories are being drawn down. But silver is still trading at a gold-to-silver ratio of around 85-1. Historically, that ratio has been closer to 60-1, and in bull markets, it compresses to 40 or even 30-1. If gold goes to 4,000 and the ratio compresses to 50-1, silver hits $80 an ounce. That's a more than 300% return from current levels. And because silver is a smaller market, it's more volatile. When the move comes, it's going to be explosive. The 1970s proved this. The 2000 to 2011 bull market proved this. Every single time we get a monetary crisis combined with inflation, silver outperforms everything. But let's talk about the third pillar, because this is where a lot of people miss the full picture. Deep value plays in the commodity and resource sectors, specifically in mining companies, are the leveraged way to play this thesis. When gold goes up 50%, a well-managed gold miner with low costs and high-grade deposits can see its stock price go up 200 or 300% because the profit margins expand exponentially. The same applies to silver miners, uranium companies, copper producers, and energy infrastructure. The entire commodity complex has been underinvested for over a decade. ESG mandates, regulatory hurdles, and Wall Street's obsession with tech stocks have starved the resource sector of capital. That means when demand picks up and prices rise, there's no supply response. Prices go parabolic, and the companies that own the assets in the ground become cash flow machines. This is asymmetric investing at its finest. You're buying assets that are hated, that are trading below book value, that Wall Street has completely ignored, and you're positioning for a multi-year bull market that's driven by structural forces, not hype. Now let's bring this all together with the action checklist, because knowledge without action is worthless. The first thing you need to do is assess your current allocation. If you have more than 70% of your net worth in paper assets, stocks, bonds, cash sitting in a bank, you are massively overexposed to the exact systemic risk we've been discussing. You need to rebalance immediately. Start by allocating at least 10 to 20% of your portfolio into physical gold and silver. Not ETFs, not paper proxies, actual physical metal that you can hold in your hand or store in a private vault. This is your insurance policy against currency debasement and systemic collapse. Next, identify 3 to 5 high-quality mining companies in the gold, silver, and critical metal space. Look for companies with strong balance sheets, low all-in sustaining costs, and projects in jurisdictions with political stability. This is your leveraged upside. When the metals move, these stocks are going to multiply your returns. Third, build a cash reserve, but don't leave it sitting in a zero-interest checking account. Use short-term treasury bills or money market funds to at least earn something while you're waiting for opportunities. The key is liquidity without total exposure to bank counterparty risk. Fourth, educate yourself on the mechanics of financial repression and the history of monetary crises. Read books like The Great Debasement, The New Depression, Lords of Finance, and When Money Dies. Understand that what's happening now is not new. It's a pattern that repeats every few decades, and the people who study history are the ones who profit from it. Fifth, stay disciplined and don't get shaken out by short-term volatility. The repo spike we're seeing right now is just the beginning. There are going to be more crises, more interventions, more headlines that try to scare you out of your position. The mainstream media is going to tell you that gold is a barbarous relic, that silver is manipulated, that you should just buy index funds and trust the Fed. Ignore them. They have no idea what's coming. Sixth, and this is critical, position yourself before the crowd figures it out. Right now, gold and silver are still under-owned by institutional investors. Pension funds have less than 1% allocated to precious metals. Retail investors are still chasing meme stocks and crypto. When the narrative shifts, when the next liquidity crisis hits and the Fed is forced to pivot back to money printing, everyone is going to rush into the same trade. By then, prices will have already moved, and the asymmetric opportunity will be gone. The time to act is when the signals are flashing red, but before the panic sets in. That time is right now. So here's my question for you, and I want you to answer this in the comments because I read every single one. Do you believe the Federal Reserve has the tools to manage a debt spiral of this magnitude without resorting to money printing and financial repression? Or do you think we're past the point of no return and the only question is how fast the system unravels? I want to hear your thoughts, your concerns, and what you're doing to protect your wealth. This is not just a passive viewing experience. This is a community of people who understand what's happening and are taking action. And if you haven't already, smash that subscribe button and hit the notification bell because the next few months are going to be absolutely critical. The repo market is sending us a signal that cannot be ignored. The dealers are cornered, liquidity is drying up, and the Fed is running out of options. This is the setup for the greatest wealth transfer in modern history, and you have a choice. You can either be on the right side of it or the wrong side of it. The information is here, the roadmap is clear, and the opportunity is sitting in front of you. Don't let fear or inaction rob you of the chance to protect and grow your wealth in what is going to be one of the most volatile and profitable environments we've ever seen. I'll see you in the next one. Stay sharp, stay disciplined, and most importantly, stay positioned. Andrew John out.